Hello, this is Jeff Sayer from 9 Point Partners. Welcome to our 2018 review and 2019 outlook presentation for the 9 Point focused family of funds, including the 9 Point Global Dividend Class and the 9 Point US Dividend Class, and the 9 Point Real Assets family of funds, including the 9 Point Global Infrastructure Fund and the 9 Point Global Real Estate Fund. Let's start our discussion on slide 7. Clearly, this was a difficult year for the U.S. markets, with the S&P 500 Total Return Index down 4.4% in USD, but up 3.8% in CAD. From peak to trough, the S&P 500 declined almost 20% in the fourth quarter, with the size of the drawdown consistent with a serious global growth scare. You may have seen some of the headlines regarding 2018. It was the worst year for the stock market since 2008. It was the worst December since 1931, and it was the worst Christmas Eve on record. On slide 8, we can see that the correction was primarily driven by an earnings multiple contraction, and to a lesser extent, a reduction in forward earnings estimates. Through the year, the next 12 months earnings multiple, and the PE multiple on the chart is the greenish line here, declined from almost 20 times forward, but really about 18 times once estimates were fully adjusted for the corporate tax rate changes, to a low of approximately 14 times forward, as fears of an impending recession peaked. On the next slide, we can see that this was also a difficult year for the global markets, with the S&P Global 1200 Total Return Index down 5.6% in USD and down 0.3% in CAD. Again, the sell-off was primarily driven by earnings multiple contraction. Slide 10 demonstrates the significant impact that currency movements had on returns in 2018. With CAD weakness acting as a tailwind for performance from a Canadian investor perspective. Unfortunately, we had our US dollar exposure heading into the USMCA trade agreement deadline on September 30th, expecting the CAD to continue to strengthen on the news. However, just as this deal was announced, the USD began strengthening dramatically in a flight to safety trade during the broad market correction. We did quickly cut our hedges down by half, but the balance acted as a drag on performance through the final few months of the year. Now let's move to our 2019 outlook on slide 12 and explain why we don't foresee a recession in 2019. On slide 12, here we can see that the JP Morgan Global Composite PMI has been falling recently, but remains in expansionary territory above the 50.0 level. We are watching this indicator closely for any additional weakness, but it's important to remember that the US Composite PMI is relatively solid at 54.4. China remains nicely above 50, with the last report coming in at 52.6, and the Eurozone is also still expanding with a PMI reading of 51.1. Slide 13 shows that the US yield curve, and here we're using the 2- and 10-year treasuries, remains flat but not inverted, which would be considered a key indicator of a coming recession. Given recent dovish commentary from the US Fed, relatively low interest rates should persist through 2019. Consistent with the prior charts, on slide 14, we can see that the IMF is not calling for a global recession in 2019 either, although growth expectations have been coming down. In fact, none of the major advanced economies are expected to meet the technical definition of an economic recession, which is 2 consecutive quarters of negative GDP growth. Global growth is expected to come at 3.7% in 2019, including the US at 2.5%, the Eurozone at 1.9%, Canada at 2.0%, and China at 6.2%. On slide 15, we can see the change in the S&P 500 earning estimates for 2019, according to Thomson Reuters Icon, now known as Refinitiv. Heading into the fourth quarter of 2018, earnings expectations dipped, with some whisper numbers even below 170, but have subsequently stabilized at approximately 174, a reduction of just over 2% from peak estimates. This still implies almost 8.5% earnings growth for 2019. On slide 16, we can see that the correction at year-end reset valuations to a level that was simply too attractive to ignore. Despite all the uncertainty, buyers were willing to step in at approximately 14 times next 12 months earnings, a 5-year low for the S&P 500. And this is why we get the V bottoming in the markets. Turning to slide 17, we've attempted to outline the various possible scenarios for the S&P 500 in 2019. Using a range of earnings estimates from 170 to 178, and remember that current expectations are calling for earnings of 174, and forward PE ratios between 14 times, which is the 2018 low, and 18 times, essentially the peak multiple in early 2018 adjusted for corporate tax rate changes, realistic expectations within a range of low single-digit to high-teen returns. But to be clear, reaching the upper end of this target range will require substantial progress on US-China trade relations. The final chart supporting a reasonably optimistic outlook for the market in 2019 can be found on slide 18. Here we can see that back-to-back years of negative returns are quite rare. Essentially, the market quickly incorporates slowing economic data and earnings estimates, and in late 2018, valuations already implied a significant slowdown. Should the actual results exceed these depressed expectations going forward, the market should respond positively. So let's now review each of our mandates, starting with the 9-point global dividend class on slide 20. In terms of sector allocation, in the table in the top left, we were overweight the industrials and communication services sectors and underweight the financials, materials, and consumer staples sectors. Geographically, we were overweight the US and Canada and underweight Europe and Asia. We also held a larger than normal Canadian dollar denominated cash position at year-end. Looking at some of our quality and valuation metrics in the table in the top right, the fund's holdings have a much higher return on invested capital compared to the benchmark and a lower dividend payout ratio. However, the fund's holdings are slightly more expensive than the benchmark since we have been willing to pay up for revenue and earnings stability at this point in the cycle. Importantly, of the 24 individual holdings in the portfolio at year-end, 20 reported a dividend increase over the past year, with an average dividend increase of 9.2% and a median dividend increase of 9.8%. The next slide shows the returns and stats for the fund. For the year, the fund was down 3.5% in Canadian dollar terms. We are trailing our benchmark since inception, and our performance was negatively impacted by our currency hedges in the fourth quarter of 2018. Although the quarter was difficult, overall we are comfortable with the performance of our dividend-focused mandate relative to the broader benchmark since inception. Thankfully, the fund has rebounded in early 2019, and we've been using the rally as an opportunity to focus even more intently on businesses with stable revenue and earnings growth, clean balance sheets, and the ability to consistently grow dividends through the cycle. The United States remains a key area of focus. However, we have recently added some attractive Canadian equities to the fund. Europe is intriguing, but given the greater exposure to emerging markets and potential fallout from Brexit, we remain underweight. Details on the 9-point US dividend class can be found on slide 24. In terms of sector allocation, in the table on the top left, we were overweight the industrials and healthcare sectors and underweight the communication services, energy, and consumer staples sectors. We were essentially 85% exposed to the US, with a few dual-listed Canadian stocks, most with at least some US operations, and a larger than normal Canadian dollar denominated cash position. Looking at our quality and valuation metrics in the top right, the fund's holdings have a very similar and quite impressive return on invested capital compared to the benchmark and a lower dividend payout ratio. The fund's holdings are slightly more expensive than the benchmark since we've been adding higher quality names to the portfolio. Of the 24 individual holdings in the portfolio at year-end, 21 reported a dividend increase over the past year, with an average dividend increase of 9.0% and a median dividend increase of 11.9%. Slide 25 shows returns and stats for the fund. For the year, the fund was down 5.3% in Canadian dollar terms. We are trailing our benchmark since inception, and to reiterate, our performance was negatively impacted by our currency hedges in the fourth quarter of 2018. Although the quarter was difficult and December was surprisingly weak, we believe that the performance of our dividend-focused mandate relative to the S&P 500, which was driven by higher growth and non-dividend paying securities in 2018, is acceptable. Thankfully, the fund has rebounded in early 2019, and we've been using this as an opportunity to high grade, reduce the beta, and increase the overall portfolio yield. We will now cover our real asset strategies, starting with the 9-point global infrastructure fund on slide 28. In terms of sector allocation, again in the top left, we were overweight the information technology, communication services, and financial sectors, in keeping with our total infrastructure approach, and underweight the utilities, industrials, and energy sectors. We were overweight the US, overweight Canada, and underweight Asia and Europe, and we've maintained this positioning given our growth outlook for 2019. As we've discussed in our monthly commentaries, we changed our benchmark to the MSCI World Core Infrastructure Index this past October for administrative reasons, which required a portfolio rebalance that unfortunately coincided with the market sell-off, which was tough timing to say the least. Our new benchmark has a much higher weighting to the utilities sector, which performed extremely well in 2018, forcing us to chase some new positions, and a much lower weighting to the energy sector, which performed extremely poorly in 2018, forcing us to unload some of our disappointing positions. To be clear, we're not trying to mimic our new benchmark, but our sector weightings were simply too much deviation for our comfort. This rebalancing exercise, coupled with our currency hedges, negatively impacted our relative performance for the year. Of the 27 individual holdings in the portfolio at year-end, 24 reported a dividend increase over the past year, with an average dividend increase of 11.1% and a median dividend increase of 10.0%. Slide 29 shows returns and stats for the 9-Point Global Infrastructure Fund. For the year, the fund was down 7.3% in Canadian dollar terms. We're trailing our new benchmark since inception, and to reiterate, our performance was negatively impacted by a rebalancing during the correction and our currency hedges in the fourth quarter of 2018. Although the quarter was difficult, and again, December surprisingly weak, the recent performance of our dividend-based infrastructure mandate relative to the benchmark has been quite good once we adjust for these factors. Again, most of our positions have rebounded in early 2019, and we have been using this as an opportunity to ensure that we have the correct stock, sector, and country exposure given market conditions. Thankfully, we are confident in our investment process and will continue to apply our disciplined total infrastructure approach, ranking our best investment ideas based on valuation, growth, and yield. Slide 30 shows our performance of the 9-Point Global Infrastructure Fund relative to the MSCI World Core Infrastructure Index and our peers since we terminated our sub-advisor relationship in October 2016. Clearly, we've given up some of our relative outperformance during the recent correction, but we expect to return to form in 2019 now that we've made some adjustments to the portfolio. Finally, let's end our discussion with the 9-Point Global Real Estate Fund on slide 33. In terms of sub-industry allocation, we were overweight residential REITs, industrial REITs, and specialized REITs, and underweight diversified real estate activities, office REITs, and diversified REITs. We were slightly overweight the US, overweight Canada, and underweight Asia and Europe. As we've discussed previously, we changed our benchmark to the MSCI World IMI Core Real Estate Index this past October for administrative reasons. But this did not require a significant rebalancing of the portfolio. Again, our currency hedges negatively impacted our performance for the year. Of the 27 individual holdings in the portfolio at year-end, 22 reported a dividend increase over the past year, with an average dividend increase of 6.9% and a median dividend increase of 4.8%. Slide 34 shows returns and stats for the 9-Point Global Real Estate Fund. For the year, the fund was down 3.4% in Canadian dollar terms. We are ahead of our benchmark since inception, though our performance was negatively impacted by our currency hedges in the fourth quarter of 2018. Although the quarter was disappointing for reasons previously discussed, we are still very pleased with the overall performance of this fund. The fund has bounced back in January, and we've only made small adjustments to the stock, sector, and country exposure thus far. We remain confident in our investment process and will continue to focus on valuation, growth, and yield in an effort to find REITs and real estate-related equities that we believe can outperform. Slide 35 shows our performance of the 9-Point Global Real Estate Fund relative to the MSCI World IMI Core Real Estate Index and our peers since we terminated our sub-advisor relationship in October 2016. Clearly, we've been giving up some of our relative outperformance in the recent correction, but we expect to regain lost ground through the coming year. This concludes our 2018 review and 2019 outlook. Thank you for your time and your continuing support.